Good afternoon, everybody. This is Chris Swift of Swift Trading Company on behalf of my partner Chris Winward and our assistant Sean Gammon. Thank y'all for this afternoon for joining us. I want to make this pretty short and sweet because y'all know how perplexed that I am about the industry right now and some of the things that we're going through. So I want to touch on three things this afternoon. Gray swans. So the black swan events has seemingly spawned some gray swans. This past couple of weeks of winter has really done some damage to the industry. It's backed cattle up, another factor that we don't need right now. So we're going to talk about three changes this year in the market that have been obvious. The egregious feeding margins and stress of inflation exposing some of this weakness. So the three things that are most obvious this year that has changed primarily is the basis. We have shifted from a positive basis over the last 3 to 4 years to now a negative basis. That negative basis tends to attract inventory. That's the reason they put the premium out there to the futures market, is we want to attract that product to that time frame. So the basis swap between positive to negative now is probably the most noted thing that we see. And more likely than not, because there is significant discrepancies between whether we do have enough cattle or whether we're short of cattle, either one, that keeps that balance probably closer to the futures continuing to hold a premium than it to flip back the other way, where the other way always encouraged marketing right up front. There's no point in holding it whatsoever. We're going to pay you the highest price today. Second is the spread between the contract months. The June-April spread to within $1, $2 is extremely narrow. So not only are hedgers able to use this in use the June contract in a negative basis format, but as well, that close proximity to the January makes that May spread between the two a lot more beneficial than what it has been in the past. We've seen a lot of forward contracts in the May contract that was 2 to 3 under the April board or 4 to 5 over the June board. Both of those were just right about in the middle. Today, with there only about a $2 spread between the two, May cattle, if a feed yard was going to forward contract that to you, then they would probably do it at pretty much even money with April or June, either one. So we know that we've been trading that positive, been trading a positive basis, $5 over the June at any given time. Now it's about $5 over the June. The June is $5 over the cash market. That's a $10 difference. I think that $10 difference was part of the factor in January to place more cattle on feed. Just the future price scheme was considerably better than what it had been in the past 4 to 5 years. So the last thing here that we've noticed, the three things that have changed, the third one being the feed cost surge. This is not due to the U.S. It is not due to any ethanol production nor increase in livestock production here in the U.S. This is China buying corn to increase their hog production in a more controlled environment. The controlled environment forces them to have to feed a clean feed source. Corn and soybeans become now the feed source rather than the swill that they used to feed over 60% of their hog production. So we believe that this is going to continue for a while, and we see breaks in the market like what we've seen over the last 2 to 3 weeks here. And then today we get further information out of South America that the crop is being impacted again by wet weather in Brazil and dry weather in Argentina. So we see corn market, soybean market react to that today. And we know that that just makes feeding margins that much more egregious to the cattle feeder. So we can see now the corn market, and this is not a, this is a correlation between the two, between the three. And what I most note about this is that we've never seen the corn price this closely related to the moving of the feeder cattle price, at least over the last 4 to 5 years. I'm sure back in times before when we saw $8 corn, that could easily have shown that. I just don't have that data readily available. But what's pertinent to it now is pretty much that 2016 time frame to forward, because that's when we had the major expansion. As we're curtailing down in the herd size just ever so slightly by what we saw in the January number from inventory report, we also know that the placements of heifers have been really low. 37%. And I'm anxious to see what that number is going to be in April when we get the finish of the first quarter out, to see if producers have continued with that holding back of heifers. So this is where I see the biggest issue to the cattle feeder right now, is that feeder cattle prices haven't come down any. They're still pretty much sitting right above that 130 level and barely been down there. And fat cattle prices just now breaking over the 110 level and hasn't moved much above 114, between 112 and 114 for the last several weeks. But then there's corn. Corn just shot straight up, and corn remains at the top end. So this shows how egregious that feeding compilation is on there. We can see throughout the years, and I want to give special thanks to Craig Purvines and the cattle range, because he was the one that provided this data for me. He sends this out every Saturday morning, and I anxiously await it to see what some of these details are from there. So we can see that most of the cattle feeding has not produced a break even over 5 years now. There has been months, and there has been a string of months at times, that did produce some profits, but the overall time frame of losses just leads you to believe that there's something terribly wrong within this sector of the industry. So we move to the feed yard closeouts, and we see how terrible they are. And my point of this is not whether you're hedged or unhedged. It really doesn't make any difference. For the last 4 months, we have been trading under profitability for cattle. We just barely saw last week where it poked up just a little bit with 114. Somehow or another, back in November, October, when those cattle were placed, there might have been something that week that caused the little bit of an up move in the 114 cash to make those cattle profitable. But clearly we can see that it doesn't matter whether you're hedged or not hedged, the live cattle market is not performing. These are the outputs, what I see and what I try to project, and I use in my analysis to predict how bad a shape is the cattle feeder in and what kind of prices does he need. And these tend to reflect a lot of the central Kansas break evens that I see, that I get on my news wires. So I have to believe that it is fairly relevant to these kinds of losses that we're going to see going forward here. So that brings us into inflation. So this is a bond chart right here. So we already know that the cattle feeder is under grave duress. So what's going to make it better or worse? Better, in my opinion, would be something that's going to impact the consumer to force them or cause them to increase beef consumption at a higher price, because that's what we're asking the packer to do. We're asking them to pay us a higher price, and if they pay us a higher price, they're going to go in, they're going to ask a higher price to the consumer. So inflation, I think, is going to be a big ordeal. And what I want to show you on this bond chart is bond prices, of how high they are and how low of a rate of interest that incurs. So if I buy a bond at a really high price and I get a really low interest rate, I've got a lot of money invested that's not going to give me a very big return. 12 years of this, just since, well, actually, yeah, 12 years, if we go back to 2011, 2012, that's when we started the big up moves, because that's when we started quantitative easing. Imagine what it's going to take to unwind those 12 years of quantitative easing, stimulus package, interest rate twists. There's no telling how much more to go. And every single day for the last 3 days, the Fed presidents have vividly said, we are not going to do anything about inflation. We do not see inflation. We've not had 12 months of inflation. So what I have to believe is, by their bond buying program, they are going to continue to put out as many bonds as they need to keep the front end flooded with liquidity. And nobody wants those bonds. So they will have to sell them at a lower price and increase the interest rate in order to entice you to buy them. And all that does is show greater reflection of inflation. And inflation is what we seem to be battling right now over the last 3 months to the cattle market, that might have had a bigger impact than what we knew. Last week, we saw a dramatic drop in the bond market, and we began to see commodity markets take issue with that. We saw the cattle market break pretty hard on that news, because we know that inflation takes away and dilutes that consumer's discretionary spending funds. So inflation is here. that bond market is probably going to continue to go down because of what the Fed's policy is and what they have stated over the last 3 days. So what are we going to do with this information? That's the most critical thing. And what I'm going to tell you is the balance between the futures market seeming as if it wants to go higher, as we can pull it off dramatic lows just about every day, and even surge it in times when there's really not a lot to surge about. But for whatever reason, the futures market is seemingly wanting to go higher. And it seems to be fighting tooth and nail with a cash market that says there's no need for me to go higher. There's no reason under the sun for me to go higher whatsoever. So what do? I think when we look at this feeder cattle index, which is the cash market, which is human beings participating in it and not have to worry about the computer algorithmic trades, if we begin to trade under 136.44, that will overlap and that will make that rally a 3-wave rally up to where you see that blue 3C right there. If that happens, I'm going to say that at bare minimum, we'll come down and retest these lows, probably about 131, 132. And if it gets really bad, then we come down here to where this previous wave 4 low was, somewhere under 130, 127, 126, something like that. It's going to, I anticipate it to be a ripple effect chain of events. The cattle feeder eventually says, I'm not going to pay for that. He gives directions to the order buyers, don't pay up. Doesn't mean that somebody else will not, but it's got to start somewhere or another. That individual says, don't bid up for them. And now we begin to see the lower price in the feeder cattle market. We begin to see less cattle placed on feed. That begins to impact the cow-calf operator, and the cow-calf operator currently under an expansion for as much as we believe. That might turn his mind into say, there's no point in expanding here. I'm just not going to get any better. They're going to start nailing me on my calf prices now, unsensitizing me to be able to do anything. So when we look at how good can the market get, it can get any good whatsoever. So what do? We try to use the premiums that are available to us on the futures market, and then use the option strategy that produces even a greater leeway to the upside. And we don't worry about what happens between now and August, because we're fixed in our price. Whatever happens, if the market drops to the 130 level and stays there, then we're marketed in the upper 150s where the futures are. If it goes up into the 150, 160 range, the futures are already there or have been close to it. And with an option strategy, you can get very close to the 160 level before you would begin to not be able to make any more money on a fence hedge. So again, our imbalance of the futures seemingly like wanting to trade higher, the cash market seemingly have no reason to trade higher. Those two indifferences don't give me any kind of leeway to really be bullish or bearish either one. What it leads me to do is think that the basis will converge. It's already wide. It can get wider, but the likelihood of it is at this point in time, maybe it's good, maybe it's not very good, but it really doesn't matter. It all depends now on whether or not we want to take the risk of saying, boy, I am so glad I listened to everybody, because they really knew that the consumer was going to go out and increase their discretionary spending habits. The pent-up demand that we believe the consumer has, I believe, is already filtered into the market. Just like what we saw when the market collapsed and beef prices gradually rose under all kinds of conditions that we never thought they would. I think the consumer has done that too. The consumer took a huge hit, and over the last 6 to 8 months, his shifts in discretionary spending habit have grown up to the point where they are today. I think you're going to have something different change economically, either an increase in wages, an increase in employment, or both, before you can really say, wow, now the consumer is really getting more funds, more discretionary funds at the end of the month. With the live cattle market, this is where our big problem is, and I don't know how to overcome the difference between what the packer is paying and what the feed yard is getting for it. I see this divide is significant. I think it's going to remain significant for a while until we get fewer cattle or fewer cattle producers. This is an unpopular comment to have to make, I've heard it all of my life because I'm kind of on the outside looking in of the industry, but I've heard it all my life. And I still get people to this day tell me the real issue is you got too many cattle out there and too many cattle producers. You have a definitive slice of the pie, a definitive pie. And of that, you have four major packers that take the lion's share of it. And you have literally tens of thousands of producers out there supplying those four major packers. There has to be a change. I wrote today that my instance in the midday cattle comment was back in the early 2000s when hog market. The hog industry was bleeding profusely. What happened was they took the price of hogs down so low that they weeded out every producer that was inefficient. I can't say that that's what's going to happen in the cattle market, but I do know that it is a fundamental function of liquidating inventory and putting profits back into it is to have to drive people out of business. You can do it one of two ways. You can either raise the price of something, possibly corn, to a level where I can't afford to feed it, or I can drop the price of the fat cattle out there because I don't need it. So I think we're looking at a couple of factors here that, again, no definitives whether that's going to make the price go up or down. But if it goes down from here, I'm going to lose some significant premium that's never been offered to me on the cash market. If I'm wrong and the market blows straight up and consumers have found this golden egg that's going to make them eat more beef at a higher price, then I could clearly see where we could move higher. And although those premiums would most likely be exceeded in the futures market, the cash market would have to move significantly in order to exceed that. Not to say that it will or it won't, but it's just going to have to do that. Again, what does it sound like to me? Convergence of basis is going to happen more so than direction. So when we look at this chart right here on the fat cattle market, I think there's 5 waves up. That C wave, the big red C wave, made the lowest low in all of this decline. And now we've moved up in a fashion and we've almost come close to equaling that 20 January of 20 high. So what if we spend the next 3 to 5 weeks where we know we're going to have maybe a plant shutdown, a kill plant shutdown in Nebraska for 4 or 5 days, where we know we've still got backed up fat cattle that really need to be sold much more than the packer needs to buy. Packer doesn't really need to buy anything. He's got ample plenty beef on hand and he can attract beef at any given time he wants to at the price that's available today. So I don't see them having to go out there and bid to bring that inventory in. I do see a cattle feeder that has had to increase feed costs because of the weather. They've had to increase labor to help combat the weather. And now they're sitting here, from what I have seen on the USDA from February the 27th, only a 2-pound loss of weight on there. They killed 666,000 head last week. They're going to flood the beef market. If they flood the beef market over the next 2 to 3 weeks, going right into the April timeframe, again, I don't see a reason for the cattle feeder to have to bid, for the packer to have to bid up for that inventory as his box prices are coming down. So all in all, I've got a little bit of a divergence between what the futures market looks like and what I may think happens and what some of these cattlemen think may happen versus what the real world is happening right here in the cash market, and me viewing the consumer facing significant inflation already with the potential to increase that inflation. Beef prices, box beef prices at the second highest ever been, excluding the April timeframe where we jumped up into $400. But if you go back into the 2013 and 14 timeframe, beef prices were in the 30s and 40s then. So here we are at 240 again. That's a really high price, and it's a really high price at the retail store too when you compare it to pork and poultry. So again, I think that there is enough reason here to be a little bit more aggressive. I tried to be really aggressive when we were at the top end of it. A few people jumped in on it. Now we see the price going down. I anticipate more people to jump on board now. If you get a rally sometime tomorrow or the next day, we start to see cash trade maybe steady or no lower than 113, 112, maybe we do get a little rally like what we saw today, and just make some plans tonight. 1, while I'm not barking your ear. 2, while the market's not trading, and just put pencil to paper and see what it looks like to market cattle at probably 128, 127, and see what it looks like market them at 105. See what the difference is, see what the option prices are and what they'll do for you, and pencil that stuff out. That's the easiest way to find all of it. You can always find the prices of the options or the prices on the futures on the cmegroup.com. So you're able to get those prices for yourself at night when nobody's barking in your ear. And I'd ask you to write them down. And I think that's one thing that we look at when we look at some of these charts here, is that it brings it to you. It brings it right up to you what that market really is. We can all judge in our heads and we can think what it looks like, but when you put it down on paper, it really changes things. So I want to wrap this up with corn. This is part of our inflationary. Corn's been going up. I see no reason for corn not to go up. And my biggest reason for corn continuing to go up is that I currently have the highest iron prices with the highest I of the oscillator reading. That leads me to believe, because I think the Elliott wave analysis still holds some truth to it, and we should get a fifth wave new high, new contract high, and that oscillator not make a new high above where it is right in here. So I think corn prices are still going higher. If I'm wrong and corn prices back up, it's only the better for you. So look at, if you got to book the corn on there, go ahead and book it. Get it done. Get your feed costs wrapped up, because here's what could happen too. The market could go up into the $6 range and $6.20 range and sit there, just like what it did when it got above 5. So we went from the 420, 430 range. We rallied up and we got up into the $5 range, and we didn't pull back under 5. We did one time right here for this little A wave, and that's it. 2 months later, we're still sitting up here above that $5 level. Next most probable move is a continuation of the up move to the upside with a new contract high, not a new contract in the oscillator. And now you got to have 5 waves up. The correction could pull you all the way back down into the $5.25 range where the previous wave 4 was, or it could stagnate just exactly the way it did right here and just stagnate for a longer period of time in a little bit larger trading range. We know that eventually we're either going to get the South American crop harvested and the corn crop planted, regardless of how good or bad it is. And come March 31st, we'll see what the planting intentions for the U.S. are, and we'll get a fresh idea for that. There is no doubt in my mind that we will plant corn from fence row to fence row and soybeans too. I don't doubt that. I have no egregiance against what the supplies may be for corn. What I'm really concerned about right now is the current demand, and I'll worry about what next year's or this year's corn new crop is going to be once we start to see how these how China continues to buy, and if we see these fifth wave new highs in the corn. So that's what I've got for you this afternoon. I'm going to urge you to go home tonight, put down on a piece of pencil and paper, see what these break evens are for your cattle that you're placing, see what an option strategy would do for you, and then consider whether or not you want to risk, all of this on whether or not the cattleman believes that the consumer is going to heal, increase discretionary spending, increase his consumption of beef, and all of the shift factors from the COVID have now been relinquished and everything's wide open again. I think people are already spending at that level. We know Texas opened up today with a no mask mandate, and all the restaurants here in Nashville, they have relieved some of the issues of the mandates for the time that bars and restaurants can stay open, plus the occupancy. So it's opening up right now. It's happening right now. And over the next 3 to 4 weeks, if you don't see any great big surge in beef prices or cattle prices, it kind of pretty much tells you the consumer's eating right at about what they want to right now to begin with. So that's what I've got. I'm going to open it up for questions for 5 or 6 minutes, if there are any. If you don't, certainly do appreciate you looking into this. Feel free to sign up for the midday cattle comment. Feel free to call us any given time. So on behalf of myself, Chris Wimber, and Sean Gammon, thank you very much for attending.
Chris, this is Joe Abbott with FCS.
Hi, Joe.
How are you?
I'm very well, sir. And yourself?
Good. Hey, when we look at this conditions out west, the way it's setting up right now, it kind of looks a lot like 12 or 14 to me if it moves into our part of the country. our projected break evens on grass, if we've got good grass, I should say our cost to gain is less than 50 cents on purchase feed cost. So as you look at these cattle that they're buying right now, plan on marketing in July and August, hedging at 154, how would you create a fence if you bought a hedge today so that you could potentially take an opportunity if the market would happen to, let's say, go to 165 or something for that 8 1/4 weight at that time?
Okay, I'll tell you what, Joe, I want to answer that question, but answering it publicly like this is going to open up a can of worms that I can't close. So I'm going to say that after this is over with, just give me a ring and I will be glad to lay that out just as plain as can be.
Well, as a lender, where I was going with this, and maybe you can answer that. As a lender, we sit there and we look at how many dollars of hedging funds need to be available.
Mhm.
We would potentially be opening ourselves up to margin calls on both of those, right?
That is correct. Yes.
Where we, okay.
Yeah, the margin, I stated earlier, starting in this year, that the capital requirements are going to be extensive. And I've been right so far. They have been enormous. The rally that we had from October to present put a lot of pressure on some hedges that were done a little bit early. The corn market has increased significantly. So just those prices alone, and then everything else out there as well. So I believe that capital is going to be huge on there. And for your perspective as a lender, what I would add to that is that your producers are looking at a range of prices that they can fulfill. If they can live with those prices, I really don't see a foresight that says that's just going to be dead wrong. You should really anticipate a 20–30% increase in feeder cattle prices or fat cattle prices, whatever that case may be. So if you have the wherewithal to stay with the margins and allow that basis fluctuation at expiration, you know that especially in feeder cattle, the basis is going to converge with the feeder cattle index, which we believe, regardless of how true it is, we believe that your cattle in your area are the most closely represented by that feeder cattle index at any given time. We fully understand that every sale barn has a different basis to the board. But as a general whole, when they combine all those as an average, that 5-day weighted average for the feeder cattle index tends to portray a accurate vision. Even here in Tennessee, we will run $7 to $8 back of that index at any given time. The index rises $5, we tend to rise $5 too. All ships rise and fall with the tide. So
the key to them is to make sure they don't exit their positions until expiration date.
Well, okay, let me clarify that just a little bit. It's not so much that they don't do it at expiration or before, it's when they sell the cattle. If they can hold the cattle to as close to the last trading day of expiration, they will have fulfilled full convergence of basis. If they are hedging their cattle and they are going to deliver them in August, but they're sold on a July special sale, July is when you lift the hedge. Because if you carry that hedge all the way into August without the cattle, the price of the futures can continue to go up and you've got to meet those margin calls. And those are realized losses because you don't have the increase in the value of the cash cattle anymore. So that is something that happens every year. There are big June and July cattle sales that don't deliver those cattle until the end of the grass season. So we run into this basis all the time with that, and there's no good way about it. There's really not. That's why I have encouraged clients to try to market your inventory as close to the expiration of the futures contract as you possibly can.
So when they market, even if they need to get rid of their positions at the time they market those cattle.
That's exactly right. Because now you have relieved yourself from a speculative position. It's a hedge position because you have the physical inventory. Once you relinquish the physical inventory, it becomes a speculative position, and then it's all yours, higher, lower, good, bad, or ugly.
And that's both positions of the fence.
That is correct. Yes, that is correct. The likelihood of you offsetting the legging out of the fence would not be very good. If one is detrimental to you, the other is as well. and trying to play catch up and say, well, I'm going to market my cattle now and I'll let the futures market come back for me and then I'll get out of them. That's a dangerous game to play. People do it all the time. But I will tell you that we don't like to do it. We try our best to encourage our clients to get rid of those futures positions at the same time that they market cattle. So when we're looking at something on a fence like this, even the options, because we're dealing with such a wide spread, we could have a $3 to $5 wide basis increase while we have the position, but the options being on a delta may only increase 50% of that or 60% of it. So you're not, with the options, you're not having to suffer through the full movement of the futures contract while that basis is still trading. So the options do offer you some relief from that due to the delta of the option. And then closer to expiration that you get, the closer that those two prices will come together. And I will note that today, if we look at March feeder cattle and we go back 4 weeks from now, that basis was 10 wide. Today, it's $1.20. That's a big difference in just 4 weeks. So somebody, that $10, somebody made because they sold futures and they bought cash. And you know what has happened? Futures have come down $5 and cash has risen $5. They made the basis spread. That's what I am trying to encourage producers to do, is make the basis spread and leave the speculation out of it until something's more clear, until you get definitive. Absolutely, the consumer can eat more beef and he can pay more for it. But that doesn't seem to be the case right now.
Thank you very much, Chris.
Absolutely, Joe. Let's see if we can get one more question on here and I'm going to let y'all go for the day.
There was this one.
Okay. So does the increased formula premiums over the past years change your perception about basis? I mean, 3 to 5 over cash is common today for the trade. So for me, that makes me wonder, doesn't make futures not as high versus past basis years when those premiums were 0 to 250, or does it matter? Basis is basis. Basis is a mathematical calculation of cash minus futures. It doesn't matter what the price of the commodities are, nor at any given time frame. It's a mathematical equation. So cash minus futures is the way it is always quoted. That's how you get a positive or negative basis. So at this time, I would say, I don't think it makes any difference. So we'll go to one more question here. And that seems to be all the questions. So I will encourage you to call me if you have anything else. If not, thank y'all very much for taking the time to listen.